Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris milling wheat, Minneapolis wheat, and London UK feed wheat. Paris milling wheat. There had been here one continuing dominant pattern, a quite large pattern, that 9 weeks ago took a break on the downside. It is, of course, the dark blue highlighted late August 24 to late February 25 ascending triangle pattern. This pattern had the requisite number combined 5+ touches and is made up from a lot of smaller patterns within it, but it can clearly be seen on my daily chart. 10 weeks ago I laid out targets below for this pattern, and I quote, primary target X would be in the 226 zone, with a secondary harder to reach target X1 down in the 194 even zone. End of quote. 9 weeks ago the market reached the primary target X, pushing down below it. However, we had a stall in the movement lower during the first part of March, prompted by the market trying to test down towards the 50% absolute Fibonacci line at 219. This action would become very crucial to what happened next, beyond the obvious significance as a 50% absolute Fibonacci line. You see, it had importance because it helped hold up prices back in November and early December last year, and also eroded the bearish incentive back in August and September as well. The reactionary rise only managed to move up to the declining long moving average, currently at 227, not even testing it, but rejecting further upside pressure. And we've dropped lower, more or less, ever since, such that we are today at lows not seen since late August. Anyway, 9 weeks ago, I amended the still open further targets below into target X1 being at 205 as a secondary harder to reach target, and target X2 being a tertiary target, an even harder to reach target down at 194. I asked the question back then, and I quote, the question still remains as to whether prices will take this time to form a possible bearish halfway hesitation, or will they recover further. The latter seems unlikely right now, and the former, well, it is too early to say, though it might comply with what is going on in the other grain markets. End of quote. I added 4 weeks ago, and I quote, comply? Well, the market did, as we've dropped down through the 50% absolute Fibonacci line and shown a new close in target X, target X4 for the bearish halfway hesitation down in the 206 zone, which I have since finessed to 208 zone. This is the most immediate opportunity on the downside. End of quote. Last week prices reached target X4 at 208, and this week reached target X1 down at 205. This just leaves a tertiary and much harder to reach target X3 down at 194. I said earlier that the action over March was going to be very significant. Well, you can see by the bright green March-based bearish shift pitchfork that it is, as this pitchfork has been excellent at showing the bearish angle of attack of the market from March until now. Prices are around the bright green middle time, currently at 207, with the bright green upper time above, currently at 214, and the bright green lower time below, currently 200, corralling the market within corralling the market lower within these times. Minneapolis wheat. Since mid-February, the market has gradually narrowed the range until late April with lower highs and higher lows. It created a sideways triangle pattern type, currently 606 to 621. It's a reasonable looking pattern, unlike some of the others in wheat, with the dark blue July 23 to date downtrend on top and the bright green early March to date uptrend below. This week prices pushed down below the bright green lower trend line. There is no bearish halfway hesitation to consider here, as we have seen elsewhere, nor is there a 38.2% Fibonacci, as that is down at 537. So it's a straightforward attempt lower, though we have support at 578, especially just above the congestion seen between November 24 to January 25, between 585 to 611, so roughly where we are now. And this explains a lot about today's action. The reactionary move, the key reversal almost that we've got back up. So there are a couple other features that I'd like to expand upon that may help in deciphering what is going on here. I've drawn a mid-March to mid-April bearish shift pitchfork, so far unhighlighted. This seems good right now despite its young age, showing the bearish angle of attack. Prices are right now between the middle time below, currently at 601, and the upper time above, currently at 625. It is a much more, well, it's a much more shallower pattern, a pitchfork here, than elsewhere. So this action has nevertheless still left us with some targets below, even though we are looking to close back within the sideways triangle. For the descending triangle pattern, we have a primary target X down in the 562 zone, not too far away, and a secondary hard to reach target X1 down in the 520 zone. Now, that being all said, I am not sure about these two, but for now they will do until I figure out what's going on with the move up back into the triangle. London UK feed wheat. There continues to be here on this daily chart, even now these many months, close to 1 year even, only one major significant pattern here, and that is the bright red, late May, early July 2024 bearish shift pitchfork. The market in late February this year reasserted the dominance of this pattern with prices breaching, then repairing an attempted break higher over the bright red upper time, currently at 175.65, back in late January and early February. To add to this, the earlier this year narrow mix overhead of all the moving averages, they're now actually separating out, the narrow mix overhead of all of the moving averages, as well as the 50% absolute Fibonacci line at 180.5, and you had, I still suppose, have a close together compacted zone area compacted area overhead that, as I've previously repeatedly said for months and months, that had been brewing up for a significant move, which happened, or I should say started to happen, over late February and into March. It was, as I said, 21 weeks ago, and ever since, and I quote, even now, still looking for that better pattern to appear, and until that shows up, I will continue utilizing the bright red bearish pitchfork, end of quote. So my point has been, and is, the bright red bearish pitchfork is, after all, the temptations of other patterns here, the key pattern still I was looking for all the time. This leads me to my final 4 points, and 3 of them were something that I noted in my recent annual commentary on London feed wheat. Firstly, I saw there the potential for a very large May 23 to date cat's ears pattern. This is a bearish pattern akin to a double top formed after a big fall, such as the fall we had earlier in 2023. As well as an even longer second pattern, August 2020 to date, very large head and shoulders top pattern. These two super long-term patterns are still live, and they both rely on one feature, that is their common neckline, highlighted in dark blue on my daily chart, currently at 167.65. For most of March, prices slid along the top of this support of these dark blue pair of necklines. However, recently we've dipped, recovered, and then again last week, and this dipped again below the neckline, setting up the opportunity for a recent possible bearish halfway hesitation, but also making the lowest lows and low closes since March last year. The third feature is a little more longer term. It is the March 2016 to date recently finessed uptrend, highlighted in purple on my daily chart, currently at 168.65. For the last few weeks, we had the market pressing on the dark blue necklines as well as this reinforcing purple uptrend. It looks right now like as if we are finally breaking below it, as well as pushing down through the congestion between March and April 2019 between 161.95 to 165.75. Now, as I've said here repeatedly, there was one major possible severe criticism of the two necklines, and that is that they have been previously breached, and some would argue broken. However, I counter that by saying that I transposed these from my longer term monthly charts, and whilst on a daily and even on a weekly chart they may appear breached and broken, on longer term monthly charts they were still really live, and they did look somewhat valid. And as I said repeatedly, and I quote, I would not take these as cast iron lines in the sand that should not be crossed, but as longer term strategic patterns that we should bear in mind and occasionally bring a closer eye upon, such as now, end of quote. This week is the first week in quite a while when I really think we have broken the back of this support. We have not only had a significant monthly close below these key necklines, but we also did it with a monthly key reversal down. Now, 1 month does not make a major change in my monthly charts, but it does set up the situation to see if May and even June will follow through lower. So watch this space carefully and closely. Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.